Hi, everybody. Welcome to the podcast. I'm Dragan Dimovski, and today we'll be discussing 5 strategies on how to make money on a downturn. And today we'll be welcoming our head strategist, Rocco Marrapodi. Rocco, thank you for coming on.
Thanks for having me. Good to be here.
Excellent. And as always, our lovely Amanda, our co-host. Thank you, Amanda.
Hi, thanks for having me again.
No problem. So, Rocco, let's get into these strategies.
Welcome to the Passive with Property podcast, hosted by Dragan Dimovski and co-host Amanda Calabria. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
Strategy 1, buy when others are fearful.
I think the first question that a lot of people ask is whether they should be buying in a market downturn. And I think one of the things that I've kind of learned is it's good to be entering when there is fear around the market, because it means that there might be less competition.
Sure.
And less competition means things like more leverage in negotiations. And it doesn't necessarily have to be price related. You could also look at things like negotiating longer settlement terms, just to give you more chance to get your finances in order and make sure everything's structured as it should be. You also get to be a little bit more picky in what you're actually looking for. There's a little bit less urgency in having to kind of get the deal done now. Mm-hmm. So you can actually take your time, make sure you're doing the proper due diligence, the proper research, and making sure that you are getting a good deal at the end of the day.
So, Rocco, I'm just going to throw a question out there. A downturn. What is a downturn for first-time listeners, people who just, first time getting into the investment game?
Yeah, definitely. So I think generally when people think downturn, they're thinking of a time when property prices are not rising as quickly as they used to, or not rising at all. Maybe they're going through a bit of a flatter period. You're generally seeing that at a time when interest rates have remained high for a long period of time. So a lot of people might point towards the last few years and expected a downturn. I think the last few years are a bit of an anomaly. It's not normal to expect that all the time. So, traditionally speaking, in the past, you probably might have seen some kind of correction or downturn in the market when those conditions were present, with interest rates being high. Obviously, it's harder for people to borrow money, less money coming into the market, and prices might get a bit more stagnant, bit flatter.
Okay. Amazing.
Why do you think people are afraid to buy into a downturn? Why is the fear there?
Yeah, definitely. So I think a lot of it comes down to just a general psychology around you're investing to make money, and people just think if prices are going down, there is no way for them to make money in that kind of environment. And I think what we need to kind of shift our mentality towards is remembering that, especially when we're using property as an asset class, it is a long-term game. It's a long-term investment. It's something that we want to kind of project out for the next 5, 10, even 15 years. And so when you're looking at these kind of downturns, or when the market's a bit flatter, that might present further opportunities for you to get yourself situated at a time when not everybody else is looking, and trusting in the fact that we do kind of go through these market cycles and things should eventually pick up again. Yep. And you're going to be well set up to ride that wave when it eventually does come.
So that little discount that you might get in a downturn kind of justifies itself over against paying more in a more competitive market.
Yeah, definitely. It can do. I mean, we can't forget about the other side of the coin as well, which is if I'm buying in a downturn, there's going to be holding costs. Like, it does cost money to hold on to a property for the most part. And so does the holding costs and getting in early, is that offset by the potential growth that I'm going to see later on, or the lack of growth that I'm having now?
And it all determines on the rental income as well that you get, in expenses and what have you.
Exactly right. And I think one of the maybe lucky things you can say, or one of the factors that really drives property at the end of the day, is demand.
Yep.
And the great thing is that whether we're going through a downturn or not, there is demand for housing all the time. Right. People need somewhere to live. So you can try and rely on that cash flow to get you through that period. But you want to try and make sure that you're also targeting the right area that should have growth when we come out of that period of downturn.
Yeah,
Yeah. So it's still buying well. It's just maybe removing some of the noise of the rest of the market bustling around you and taking your time, buying well, hopefully negotiating some form of discount to justify those holding costs, or as Dragan said, using the cash flow to
Absolutely.
cover that for you. So you recommend that, or I suppose you would say that buying in a downturn can still be lucrative if done well.
Absolutely. I don't see a downturn as a time to not be buying. I see a time for you to be really strategic, and whether that means understanding the market, speaking to a buyer's agent, speaking to a professional, someone who's got knowledge of the industry, and just really identifying what is going to drive markets at the end of the day, and then understanding whether those factors are present in the areas that you're looking for, and that can give you a good idea of whether it is the right area to be buying into. And whether it's a downturn or not, you definitely want to be buying in the right area.
Yep.
You mentioned negotiating on terms can be an advantage. It's not just about price. And you mentioned something about longer settlements.
Mm-hmm.
Why might something like a longer settlement be an advantage in a buyer's market?
Yep. So I think when it comes to settlement terms, it can be an advantage for people who are still trying to get their finances together, especially that might be one kind of advantage of going into this quieter market with less competition. You don't want to fall into the trap of rushing to get your funds together, rushing the deal through because the agent's telling you they've got multiple other offers that they're kind of looking at, and then you end up overpaying by potentially tens of thousands of dollars, which will make a big impact on your bottom line at the end of the day. So having that extra time to kind of make sure you've got the right due diligence, the right research, the right understanding of the property can be advantageous. It gives you more time to get things like a building and pest inspection done, understand the structural integrity of the property, understand whether there might be any issues potentially that could come back to bite you later on. So just giving yourself that extra time so that you don't have to rush into a transaction.
Strategy 2, more aggressive on terms.
So we've just talked about things like extended settlements and negotiating in different terms in a downturn. Vendors who are struggling to sell their property in a downturn might find that they have to be a little bit more giving with buyers that are willing to buy their property but might want certain things to their favour. So, for example, and this is becoming a lot rarer, but things like early access. So early access might be, allowing the purchaser to enter the property prior to settlement for things like, cleaning up, taking possession, storage, paint and carpet even. Obviously, as the purchaser, you'll need to take out the necessary insurances. Make sure that, even though you're not the titled owner of the property, that you are accessing the property or taking occupation of the property prior to settlement for the purpose of property improvements. So that can be a term that can be negotiated in a downturn where there are no other buyers. You talked about buy when others are fearful, there's less market competition. So in that case, instead of waiting for settlement, and then once you're paying those holding costs and those loan repayments, then doing paint and carpet, you might be able to negotiate access prior to settlement. For those works. It is becoming less common for insurance purposes. A lot of vendors are reluctant to allow access to properties before that handover takes place. But again, in the absence of competition, in the absence of other buyers with good negotiating and proper insurances in place, and a desperate enough vendor in some cases, you can absolutely negotiate in early access. The same would apply to things like a deceased estate, as an example. So say, somebody's passed away during a market downturn. There's never a good time to pass away, but a downturn is certainly not a good time either for the family that remains and then has to sell the property, because again, they're selling into a quiet market. So in the case of a deceased estate, where perhaps, there are 3 or 4 adult children all busy with their own lives, their own children, they might live interstate, they might be out of area, they've now been suddenly left with mum and dad's place that's, full of mum and dad's belongings. Maybe they've cleaned out the things they want to keep, but the place is in original condition, or it's run down, or it needs work, or it needs cleaning up or decluttering. Again, in a downturn, as a purchaser, you can potentially negotiate in, look, I'll purchase this. I might ask for my extended settlement. Look, I need 6 months. During that 6 months, I'll clean it up. That's fine, but I want a discount in exchange for that. So even circumstances during a downturn, often, people aren't selling because they want to, they're selling because they have to.
Mm-hmm.
Otherwise, they'd wait for a better market in many circumstances.
Yep.
And on that same note, particularly where the property that you're looking to purchase is unencumbered, where the vendor doesn't have any loans outstanding on that property, like in the case of a deceased estate, or, in the event that it is a property that is paid off, you can look at things like vendor finance.
That's right. Yep.
So again, it's not as common, but it is a path towards ownership where instead of necessarily financing formally through a lender, you might come up with or negotiate an arrangement with the vendor where they, partially or wholly finance part of that transaction. The other factor, and, this could be more of a Sydney-based advantage because, we've touched on this in other podcasts, where in Sydney it's become increasingly common to purchase with what's called a Section 66W, which is a forfeiture of your cooling off period. So that means that at the time of purchase, you are purchasing unconditionally, you're forfeiting your cooling off period. So Rocco spoke earlier about...
usually happens in auctions.
Purchasing at auction conditions. Yeah. So you mentioned earlier, building and pest, all of that is usually done within the cooling off period.
That's right.
But in the case of a Section 66W, and every state has their equivalent, you forfeit the time where you can actually pull out of the contract if you do find a problem with the property.
That's right. Usually with a 66W, they would already have the building and pest inspection done for you.
Correct. But then if you don't secure the property, you've outlaid the expense of those reports. So you carry risk.
Yeah.
Whereas with a cooling off period, you've secured the property before carrying the risk of paying for those reports. In the case of a Section 66W, you've paid for those reports, like prior to auction, you don't know that you're going to be the winning bidder.
That's right.
But you still had to pay for those reports because you're not going to effectively have a cooling off period. So in the case of a downturn, where it's less about locking in an unconditional purchaser and just locking in any purchaser because they need to offload that property, you can then renegotiate back in things like a cooling off period or a subject to finance clause, which in a hot market, no vendor is going to accept a subject to finance clause because there's 5 other cashed up buyers ready to rock and roll.
Right, yeah.
But in a downturn, you might get clauses like that. So you can actually bake in what we call exit ramps in your contract in a downturn because a vendor doesn't have the choice to go with another buyer who can settle quicker or who can go unconditional or who can pay more or who doesn't want access prior to settlement.
That's right.
So as a purchaser in a downturn, and again, you touched on this, it's not necessarily about price, it's about terms. And you can be really aggressive on terms during a downturn because the power is with the buyer. That's why we call it a buyer's market. The power is not necessarily with the vendor where they can pick from a pool of buyers. In this case, you as the buyer can pick from a pool of vendors and go, well, that vendor is going to give me access prior to settlement. That vendor won't. That property might cost me $5,000 more, but I get to do my renovation before I'm paying $10,000 in holding costs, and he'll give me a longer settlement. So it doesn't necessarily come down to purchase price. It can come down to terms during a downturn, and that will obviously come down to how well you negotiate in that market when you don't have the competition and you can ask for more than you otherwise would be able to get away with asking for.
Strategy 3, forcing equity in a downturn.
A lot of the times people are wondering, how can I try and manufacture growth at a time when the market's not doing the work for me?
For sure.
And this is something that our clients come to us all the time to ask us about. It's actually one of the main strategies that we have is around manufactured growth.
That's right. So one of our most popular.
Yeah, absolutely. And so basically there's a couple of different ways that you can try and go about this. So the first one is, securing some land that has the potential to be developed. And, you can get your DA approval and look at kind of developing house, granny flat, duplex site, whatever it might be down the track.
Okay. Let's work off one example as maybe a house that, you can hold for a little while and then add a DA and then sell it that way to a potential developer or, a mum and dad that are looking to, who are already experienced in property investing.
Yeah, for sure. I mean, there's kind of two roads you can look at.
Okay.
You can get your development approval and you can just flip it with that development approval in place. make some quick cash.
Yeah.
And that approval lasts for 5 years,
By
doesn't
5
it?
years,
right.
exactly right.
Yeah.
And that kind of leads into the second way that you can kind of potentially look at it is say, okay, if I've had a look at the portfolio, I understand my holding costs, I understand that it's affordable for me to actually hold on to this property. You can sit on that approval for that 5-year period, wait for the market to turn. You can develop yourself during a time when the market's turned around, it's doing the work for you, and you're selling at a better price, essentially. Yeah.
So Rocco, maybe mention one of those examples with a house at the front, and then
Yeah, definitely. I think one of the common examples that we see with our clients is having a house maybe at the front, or a house with a block that's big enough to actually develop another dwelling on, and understanding. Okay, speaking to the councils, getting understanding, getting their approvals, making sure that it is possible to actually develop there. And then sitting on that for a few years, waiting for your cash flows to improve, maybe your equity position to improve, so you have better capacity to actually borrow and spend money. And then going ahead and building another dwelling.
That's right.
And that second dwelling then obviously gives you instant equity uplift. It gives you better cash flow. And then because it's a brand new build, you get all of the extra depreciation and tax benefits that come along with that as well.
Correct.
So sorry to interrupt, I'm intrigued by this because there's sort of two different ways you could time it, right? It could be an existing property that you've held that has grown during a good market, and then in the downturn is when you build your second dwelling. Or you can purchase during the downturn and then wait for the growth to do the second dwelling. So it's a win-win, really.
Absolutely. I mean, yeah, like you said, there's two opportunities there. There is the opportunity to buy in that down market, so you're getting things at hopefully a cheaper price and better conditions and all of that. Or there is the opportunity to say, okay, maybe now's not the right time for me to buy, or I can't quite identify the right thing to look at. But in a down market, construction costs should be down as well because there'd be less demand for it. And so this might be the time to look at your existing portfolio and say, where can I make improvements? Can I develop this land? Can I put a granny flat at the back of this house and improve the cash flow, improve the equity position?
Yeah. So, and I just want to make it very clear with listeners out there, they're thinking, okay, well, this sounds too complicated. Well, it's not. So here's a perfect example. And I'll use a client that I recently had a chat to who's moving forward with a property they're going to build soon. So they purchased a house it was in a suburb in Brisbane, 1,000 square metre block. Now, they're just purchasing a normal house. It's a 4-bedroom, 2-bathroom. We made it into a co-living, so that purchase was over a year ago. It was a $750,000 purchase. Now the value is well over $900,000. They're pulling some equity to build the second dwelling at the back. Now, it's as easy as these days you actually have builders that do the full turnkey for you. So what that means is we've already done the due diligence from the start before even purchasing the property, knowing that yes, it can actually be subdivided into a 1 into 2 blocks. Yes, you can build another 4-bedroom, 2-bathroom house at the back or on the side if it's a corner block. The house there actually that they've paid that much are getting paid $750,000. They're getting $1,000 on co-living per week, which is great. Now they're using that rental income and that equity to fund the next house of the build, which is amazing. So there's another little thing that most people don't talk about is land tax. You're still paying the same land tax on that property, but you're having a second dwelling. Okay. Now, keeping in mind, when you're holding this property, you don't actually have to go off and actually subdivide that property. Okay, you can actually have it under one title when you're ready. One day, if that's where your strategy is heading, subdivide it then, and then sell one off and pay down the debt on the other, whichever which way that goes. Selling the older one or the newer one will determine on the strategy. So it's not as hard as people make it out. But going back to what I was originally saying, if you are fearful, okay, just buy the standard house on a large block, sit on it for a while, buy a few, maybe 5, 6, 7, 10 years down the track, go back to the first one and go, okay, well, now I'm a savvy investor. I'm ready to do that next development.
That's what you do in your downturn.
That's what you do in your downturn.
You reassess your portfolio.
And the reason I say this with confidence is that's what I did 10 years ago.
Yeah.
I was, having a mentor on board. They pretty much told me, hey, you know what, buy houses with larger blocks. It's almost like land banking. Well, it is land banking in a way, but you've actually got the house at the front to the renters to be paying that house off for you.
Yeah, you're preserving your debt repayments while you're building.
Exactly.
Yeah.
Exactly.
So you're saying in a downturn that's what we need to be doing, reassessing the portfolio and looking for ways to manufacture growth.
Absolutely. I mean, I'm always approaching things from a strategic point of view. And definitely, if you want to be strategic about your portfolio, you need to be strategic about your actions as well. So when is it a good time to acquire? When is it a good time to consolidate? When is it a good time to develop or improve? But leading me on to another point, so obviously, Dragan, you gave a great example about sitting on the land and waiting for a better time to develop. But there's also opportunities just to improve your existing portfolio. It doesn't necessarily need to be a brand new development or adding a second dwelling to the back. You can look at the opportunity to say, okay, have I been sitting on a diamond in the rough, or is there potential to go and purchase a diamond in the rough? So what do I mean by that? A type of property that you might have heard that saying before is buy the worst house on the best street or in the best suburb, and going in, doing the cosmetic renovations, doing the small improvements, and being kind of strategic about those improvements as well. We don't have to rip it all out and do everything brand new. Sometimes a bit of paint, an extra wall here and there, a few $1,000s of investment can mean potentially $50,000 or $60,000 of extra equity in a property for you.
That's right. And we spoke about this in the last podcasts or a few before that, where we look at a house with a 3-bedroom, 2 living areas. And, you spend, $5,000 or even less to put up a wall and a door, and suddenly you've got 50, 60K equity uplift.
You've got a 4-bedder into a 3-bedder.
4-bedder into a 3-bedder, that's right.
Absolutely.
Yeah.
Absolutely.
And that increases rent as well.
Yeah, exactly.
Sounds like
right.
a downturn is a bit of a playground for investors.
For sure. There's just the opportunity to find things that other people are not looking at because they're too scared to be looking at that point of time.
That's right. Strategy 4, target high yield stock.
Yeah, this one's one of my favorites because during the downturn, a lot of your mum and dad investors exclude themselves from the market, right? So a lot of mum and dad investors, they'll enter the market because they've had some equity growth in their own home and they want that money they have to work for them, so they'll look at purchasing an investment property, and they'll do that when there's confidence in the market. But when there isn't confidence in the market, when you have a downturn, the first people to be scared off are your beginner investors or people that haven't invested through a downturn before. They'll usually proceed with caution or they'll back off and observe. So what that means is that you have fewer investors in the market. You tend to have your seasoned investors, so the ones that are quite cashed up, looking for, we call them bargain hunters, right? They're cashed up, but they're only going to pull the trigger if something is absolute, bargain basement prices, because they're just bargain hunting until the market moves again. So what I always say to our investors is, well, you're not a mum and dad or a beginner investor because you've got the backing of a buyer's agent helping you, but you're also not a cashed up, seasoned investor that's just bargain hunting and just, I call it throwing darts. They just throw darts at everything and wait for something to hit. They're not as discerning because they don't have to be. They're just throwing darts. So what I say to investors is you're actually your own niche market in a downturn because you've scared off the beginners and you're not playing in the same markets as your sophisticated investors. You're in your own lane and you actually have unique opportunities with very little other competition. So what I say to those investors is that's when you need to look for your high yield stock. So stay away from your owner-occupier areas, so areas where you have a higher proportion of people living in the property that they own. You want to stick to your areas where there are low vacancy rates, but they are renter areas. Because you want areas where you're always going to have a tenant. You still want good quality stock, but you want to stick to those investor areas where other investors aren't quite playing in just yet because of market forces. So you want to prioritize your cash flow in those areas. Owner-occupier areas tend to have lower yields, whereas investment-grade stock, we're looking at higher cash flow. So Rocco mentioned earlier, you want to preserve your cash flow to justify buying in too soon because you still have holding costs. So you're looking for cash flow to hold that property for you hopefully it's positively geared or close to it, to hold that property for you. So what you need to look for is investment grade stock, such as things like dual key investments. So you might look at something like, a house with a granny flat, or adding on your own granny flat, like you said. You might look at, in the case of a dual key, you might have somebody that's previously done a knockdown rebuild and built a duplex, and then the market's cooled off during their development. So now they've got, two sides of a duplex for sale. You can purchase that as a dual key and pick up a bit of money there and do depreciation on a new build. You might look at some left field sort of things, things like NDIS housing, where it's a higher cash flow depending on what you purchase. This is a very niche area. It does require professional advice. But just as an example, you might start looking at left field investments like that.
Sorry, Amanda, explain what NDIS, I'm sure a lot of listeners won't know what that is.
Yeah, so it's otherwise known as disability housing, where you have, very, very briefly, I'm not going to get into it, but you have different tiers of housing where homes have been purposefully modified to assist with disability living.
Yep.
So, for example, you might, again, I won't get too into it, but you have a government subsidised renters living in these homes. So it's guaranteed income in the sense that you're not relying on your tenants to remain employed during their tenancy, because the government is subsidising it. With that being said, though, the properties are purpose-built or purpose-modified.
Yep.
So things like resale, compliance, all the rest of it comes into it. Again, professional advice is needed there, and also a specialist property manager. Yep. But again, with that being said, because they are investment properties only, they're not sold to owner-occupiers.
Sure.
They can only be sold from one investor to another investor. So in a downturn, when you have an investor, like a mum and dad investor that goes, oh my God, I can't hold through this downturn, I've got to offload properties, they're going to offload whatever they can. So things like these NDIS properties start coming back onto the market. Now, owner-occupiers aren't going to purchase a fully modified, occupied by individuals. They're not purchasing that. It can only be sold to another investor. So this is where you would then come in as the purchaser and negotiate in a discount, because again, there's a scarcity of buyers, particularly for a property like this where there's no owner-occupier demand. And that's why I said stay away from owner-occupier areas. You want to go where there's no owner-occupier demand, because you have fewer investors in the market to compete with, and you're going for areas where you're not competing with owner-occupiers who are emotional purchasers and willing to pay more. So with things like NDIS, and they don't have to be NDIS, that's just the example that I used, the disability housing, but in that instance where a property has been so very clearly set up to exclude owner-occupiers from purchasing, again, it gives you negotiating power. Same with those dual keys that I talked about, where a developer has either run out of money or done their development at the wrong time. So they're selling both sides of a dual occupancy because they either couldn't get the subdivision or they couldn't complete it, or they've had to offload it because they've run out of money. For whatever reason, they're selling the whole development in one line. We call that in one line, meaning that the titles haven't been divided or subdivided individually. So you then have to purchase both sides.
Yeah.
As an investor, that gives you two incomes, but it also rules out owner-occupiers who only want one side, not both, or it rules out investors who either aren't in the market or aren't in a position to purchase something that is a dual occupancy. So I suppose it's a case of choosing not just areas, but stock types that the market has ruled people out of. So during a downturn, owner-occupiers operate in any market because they're not purchasing to invest, they're purchasing to live. Yeah. So those owner-occupier areas where people are looking to upgrade their home, they're static regardless of the market. I mean, they might wait, they might delay, they might read the market to a degree, but those markets tend to be a bit more owner-occupier driven. Those investor markets, when investors are not playing in the market, those are the ones that you want to hit during a downturn. And it's not just the markets or the price points, but also the stock types. So that's what I always say, as long as you're still getting your cash flow, or, as you said earlier, locking in future potential with those diamonds in the rough. What some people do as well is they start to look perhaps in regional areas. And when I say regional, I don't mean isolated. I still mean anchored to a major city. But they might start looking at cash flow in those sorts of areas, because when your big cities are underperforming, then your regionals typically will as well, to a greater degree. They'll become even more affordable because that money's got to move back towards the cities. So particularly when the cities are more affordable by comparison. So it's a matter of identifying where the markets lock people out when we're not in boom times.
Yeah.
And knowing how and when to identify those markets. It does help to have a good buyer's agent advise you. And it does help to start noticing patterns. A lot of investing is pattern recognition. So, okay, when investors fall out of the market, and this is, I'm going to deviate. I do this all the time in podcasts, but I am going to deviate because I talked about owner-occupier-driven markets. I just want to talk very quickly on investor-driven markets, because this is where a lot of buyer's agents undo themselves. They'll pick a suburb and they'll call it a hotspot, okay?
The boom suburbs.
But this is the thing, they're self-prophesizing, because what they'll do is they'll pick a hotspot. You'll get 5 or 6 buyer's agents that concentrate themselves on this hotspot, right? So they become their own market.
Yep.
Okay? So that buyer's agent might have 20 clients, that one's got 20, 30, 40, whatever. They create the volume of transactions and therefore the
area.
demand for that. So they self-prophesize their own hotspot.
Yeah.
And then what they do is they go, okay, we're done with that area now, we're going to move on. But when they move on, they take that whole market base with them, because the market base was built entirely of their clients. So when we talk about investor-driven markets, make sure, and there's a caveat here, make sure you are not getting into the bubble of what a conglomerate of buyers agents is targeting, because once they remove themselves from that market, you then get the bust that follows. So when I say target investor-grade stock, I don't mean the hotspots. Stay as far away from hotspots as you can,
It's
because
just a marketing technique they use.
they're self-driven, self-prophesizing markets. You don't want an area that's 100% investors, particularly those affiliated with buyer's agents, because, again, they deflate their own market when that buyer's agent stops operating in that area. What I mean is the good quality, good cash flow, high rental yield areas where the investors are investing, not where your hotspot-based buyer's agents are investing. And I just want to make that point really clear, because they're bubbles. They're self-constructed bubbles that we want to stay away from.
Yeah, definitely.
So in a downturn, that's how a lot of buyers, investors manufacture demand in certain areas, because they are feeding it that demand. You still have to make sure the fundamentals are there. When the investors leave a market, it's still got to be buoyant enough to survive the downturn. But also, opportunistic enough for you to find a great opportunity as well.
Strategy 5, prepare for the next cycle.
Yeah, perfect. So a big question that we get, Dragan, I'm sure you can agree, is how do I know when it's time to get ready? Or what do I need to do to get ready for when markets are going to eventually turn? And there's a couple of things that we want to kind of look at. So the first one is obviously taking stock of your existing portfolio and just making sure that it's as efficient as it can be.
Sure.
So whether that means, speaking to your broker, or understanding where your loans or how your loans are structured, whether they need to be refinanced, if you want to look at interest-only options as well. So there's always been a bit of a stigma around interest-only loans, especially when I kind of first started in the industry. I think interest-only is a really powerful tool that people have to not be afraid to use, because it can help you get ahead significantly. What I mean by that is, like we mentioned we touched on earlier, property investing is a long-term game. We need to be in it for the long term. And a lot of the times when you see people say that they've made a mistake in property, it's either because they said they bought in the wrong area, or they couldn't afford to hold on to the property. So when we look at that kind of couldn't afford to hold on to it, that usually has to do with cash flows. And if you can't afford to hold on to the property for a long period of time, you're excluding yourself from that potential growth of, the 10-year cycle. So what kind of ways can we look at to actually help you hold on to that property? Obviously, tax and depreciation is a big one, but interest-only loans is also a big one. They significantly, or maybe not so much in the recent times, but if we think back to when rates were a little bit lower, they significantly reduce your repayments and therefore put a lot less pressure on your cash flow, which in turn can make it easier for you to actually hold on to that property, give yourself the opportunity to actually realize the growth on it.
Yeah.
So understanding your loan structures is pretty important. And then you can start thinking about, okay, when opportunities do start to arise, what do I need to do to be ready for those? So I know a lot of investors will look at kind of releasing equity from their properties, having that sitting in an offset account so they're not getting charged any interest, and that way they've got the cash and the deposits ready to go. And as markets start to move again, we talked about conditions before and being able to be a little bit more aggressive on negotiations in the downturn. As more competition starts to come back to the market, obviously you start to have to be a bit more decisive and maybe concede a little bit more on those conditions. So having your deposits and your cash ready to go and maybe offering shorter settlements during a kind of more competitive market can give you that edge, especially when you don't want to overpay.
Yep.
So rather than getting into a bidding war, sometimes a seller just wants to get their money quickly. So having the money ready to go can be really advantageous. So that's kind of getting ready to pounce for the next opportunity. And then you also want to obviously take stock of your current cash flows and how the portfolio is actually performing. A lot of investors who don't have a good communication or rapport with their agent can be sometimes years behind their rental reviews.
Mm-hmm.
And I've seen this happen in my own portfolio when I first started off. I didn't really speak to my agent much. I didn't really know what was going on in the market. And by the time I got around to doing a rental review, it had been 3 years and I had to hit my tenant with $100 increase. And that can be pretty hard to digest for some people. So making sure that you're consistently on top of those rental reviews, speaking to your agent, understanding, hey, what are the trends in the areas? Are rents going up? What's the bracket that we should be in? And just making sure that you're on top of those and passing those along when it makes sense to pass them along.
Yeah, yeah. I was always, against my clients, and he's a great tenant, and I've had him for the same rent for the last 5 years. Ago, treat it as a business.
That's right.
It's not personal.
That's right.
I think as well, though, you don't want to lose a good tenant either. You've got to weigh up the benefits and if they've kept the place in good condition and they're not calling in a maintenance request for every little thing. You can sort of cop $20 a week on the chin for
of course.
You know what I mean?
Exactly.
I think
where I'm going with this, it's the difference between $500 and $620.
Yeah.
Where I've seen a lot of clients who have come on board, and I've seen these type of figures, and restructuring their portfolio where I'm looking at it and go, okay, well, I think you got to increase the rental. Sure, you could still be favourable for the market rates.
Yeah.
But there's a big gap there.
Yeah. I think as well, a lot of people, they've had people in there for years and the property's due for a revamp. It might need carpet, it might need paint because that tenant's been there for a long time on a reduced rent. You've got to be careful as well if you do hike it up that $120, $130 a week and they go, all right, see you later, I'm moving out. Well, you're now up for $10K worth of renovations.
So
just being really careful giving blanket advice.
Exactly.
It's case by case.
Case by case, yeah.
Which is why I kind of made the point of keeping up to date with it as often as you can, so that you don't have to get to the point where you have to increase it $100 to get back to your market rate. It might be a $20 increase or a $30 increase. And exactly as you mentioned, Amanda, like if you have a great tenant, I think it is a business, but it is also something where you do have to be reasonable. It is someone's living there. If you have to cop $20 on the chin, like if market's at $500, they're a great tenant. They're at $450, put it up to $470, $480.
Yeah, exactly.
You can cope with that. You also have to think as well from a business perspective, if they were to kind of decide to move out, for them to go back to the market, that's the prices they're going to be looking at, and they have to go through the hassle of moving out.
There's a cost there as well.
Things cost incurred for them. So they'll obviously appreciate you being a little bit lenient with them. And obviously
it all comes to fairness.
We want everything to be fair. But I definitely think, consistent portfolio reviews, but especially in a downturn, can make the difference between long-term success.
For sure.
Yeah, and I suppose it's good that you mentioned tenants in a downturn as well, because we said that a downturn is when a lot of investors can offload properties, particularly if they're freaking out about costs or they're not, I suppose if they're not investors that have a couple and have seen a downturn before, they might panic sell. So you would see a lot of renters that are displaced in the event that the property they're living in is sold, because now we have so many more protections for renters that there are very few reasons now that you can ask a tenant to leave. So I think it is being mindful of tenants in a downturn as well, because that's when their supply dries up a lot of the time.
Exactly.
Yeah.
So that was the 5 strategies we covered today, and with our head strategist Rocco and co-host Amanda. Thank you very much, and thank you everyone for further details. If you want to have a discussion with us, we'll have a link below. Booking a call. Happy to have a chat with you guys, and until next time, thank you.
The Passive with Property podcast is brought to you by the Buyers Agency Australia.